And welcome back. In this session, we're going to take a look at mutual funds, exchange-traded funds, and maybe say a few words about segregated funds as well. This session is really the third session where we talk about specific investments in this personal finance course. We've already had a chance to talk a little bit about stocks and bonds, and today we're going to take a look at some of the other products that are, well, some of the better known products sold to new investors, and particularly new investors. Nothing that we're going to look at today goes into a great amount of depth. In fact, we have a course, a specific course that looks entirely at mutual funds. I'll talk a little bit more about that later. Next in the program, we'll be taking a look at retirement products and estates. But for today, we're going to specifically be looking at the kind of funds that are created for quite often new investors, small investors, quite often some of the less sophisticated clients that we have. They are characterized as pooled funds, and that means that essentially we're going to take the investments of a lot of small investors, put them together to try to create economies of scale so that we have the ability to provide additional and analytical power, to provide purchasing power for those stocks, even though our investors individually are going to put a small amount of money into the fund. Mutual funds are characterized as being run by professional managers, well qualified, lots of experience, backed up by strong teams of analysts. They're compensated by fees that they receive from investors, and we'll talk about the structure of fees in a couple of minutes as well. And in pooled funds, essentially rather than buying the stocks or the bonds, the investors are going to receive units. In other words, the mutual fund itself becomes the investor. And as a participant, you receive essentially a piece of paper that says that you are a participant in that mutual fund. As a participant, you're entitled to receive all of the returns that any other investor would receive, including things like interest, dividends, and when the stocks perform well, capital gains. From our textbook, you can see that the structure of these type of investments essentially brings together a number of small investors. On the left-hand side of the page, we have a number of investors, looks like 7 different investors who've put up between $2,000 and as little as $100 to invest in this particular fund. The total funds raised, in this case, the net asset value per share, net asset value of the fund, is $5,000. That money is provided by the mutual fund to an individual fund manager who, alongside of analysts, will put together a portfolio of investments. In this case, we've got another 5 companies, and varying amounts will be invested from this fund of $5,000. Again, the total amount invested is $5,000. So if you're investor D and you put in $825, you'll have a stake in the investment in these 5 companies, but not a direct investment in any of them. We can see from some of the material in our textbook some of the advantages and disadvantages. The most important advantage for a small investor, even with a few $100s invested, you can have a fully diversified portfolio. The fund itself will invest in many types of investments, so you're not really going to have to worry about one particular investment doing badly. The market perhaps could do badly. That could affect the entire portfolio. But investing in a broad diversified portfolio reduces the exposure in particular to a single problem stock or problem bond. Transaction costs are reduced because of bulk buying power. Essentially, all of the small investors got together, they hired a manager to work for them, and that's going to reduce the transaction cost. Because the mutual fund portfolio itself is a standardized portfolio, it's more marketable, management is professional, records are kept by the mutual fund organization. You can buy in for a very small investment. That's one of the main attractions. For $100 a week or $100 a paycheck perhaps, an investor can eventually build up a substantial stake and use this as a savings vehicle. And for that reason, it's often one of the first places that new investors start. provides access to stock markets, allows for reinvestment of dividends and capital gains without transaction costs, and provides a lot of convenience. On the downside, of course, there are still going to be management fees that are going to be shared among all of the other unit holders in the mutual fund. There are going to be selling charges because when the mutual fund salesperson contacts the investor, there's obviously going to be a significant amount of effort on their part. Limited control over your investments. You have no ability to select. You have no opportunity to learn from your mistakes. There's going to be perhaps unexpected tax liability when the fund produces capital gains or dividends, and the ability to buy and sell mutual fund units might be limited, especially for some less liquid funds. Now, the industry itself has been segmented between the investment dealers who we saw earlier when we talked about equities, and in the mutual fund area, we have the Investment Funds Institute of Canada. They're the self-regulating organization which manages mutual fund dealers. They also are responsible for public education and for policing their own industry. The education that's provided to people who work in this industry is provided through the Canadian Investment Funds course, or the Investment Funds in Canada course. Essentially, that's the mutual fund licensing examination process. We offer access to this through our Finance 344 course. You might want to look into that later, but let's talk about mutual funds first. There are two main classes of mutual funds, the closed-end investment funds and the much more commonly used open-ended investment funds. Closed-end investment funds essentially have a fixed number of units that are available for sale. When the fund is established, the fund manager will say, we're going to create a fund of this many millions of dollars with this many units available for sale. Once the fund is fully subscribed, once all of the original units are sold, the only way that you can get into the fund is by buying units from somebody who's selling. Essentially, that means that the supply is going to be fixed, and when the fund is particularly well managed and is successful, the price of the units will rise. This type of fund is typically traded on a stock exchange, including the Toronto Stock Exchange. Brokers receive commissions. There are no fees that are paid to the salespeople for this. The more common type of investment funds are the more standard mutual funds that we all recognize. Essentially, there are a massive number of different mutual funds that you can invest in. Many of them are managed by Canadian banks and other financial service institutions, some of them very well known, and many of them will have a variety of different alternative selections, different types of funds for different types of investors. Because they're open-ended, they don't have a fixed number of units available for sale. The more people who want to buy into a fund, the more units that can be created. So that's what we mean essentially by open-ended. Mutual fund companies sell directly to investors, and as an investor, you can redeem the units at any time. They're not directly transferred from one investor to another. They have to be sold back to and sold from the mutual fund dealer. And so there we have it. This infographic essentially shows us that in a closed-end fund, the buyer and the seller essentially meet and trade on an organized exchange the mutual funds between each other. The number of units in the fund rather, is going to be fixed. In an open-ended fund, a typical mutual fund, funds are purchased and units are provided to each of the buyers through the mutual fund itself and the fund manager. The fees that are charged in open-ended funds come in a variety of forms. It's possible to see a fund advertised as having no load, and that suggests that there is no cost of management, which clearly is not true because there are people who are doing the sales. There are fund managers who are managing the funds and doing the investments. There are back office people who are processing transactions. And all that's got to be paid for somehow. Essentially, in a no-load fund, there's no fee charged at the beginning or at the end, but there is going to be a margin that's earned from every transaction by the fund manager. And from that margin, the mutual fund salespeople will be paid their commissions and the overheads will be covered. So there's still going to be management expense, even in a no-load fund. It's just not an upfront sales fee. An upfront or front-loaded fund essentially means that you have to pay a percentage of the purchase price at the beginning. Now, obviously that seems like a large expense, but it does mean that anything that comes afterwards will be without a charge or a lower annual charge. A back-end fund essentially means that a percentage of the purchase price, or more likely the future market value of those units, will have to be paid when you sell the shares, when the fund manager redeems them. Deferred sales charge is kind of a combination where you are not going to be charged a fee up front. You'll have a back-end fee, but that back-end fee will essentially be forgiven after a period of time. So if you hold on to the mutual funds for a period of perhaps 5, 6, or 7 years, after that time there will be no back-end load. Enough profit will have been earned from the growth within the fund. An example of a typical front-end investment, in this case, our investor Don had $3,025 to invest in a mutual fund. The mutual fund has a front-end load of 4.75%. The mutual fund units themselves sell for $10. That's what we mean by NAVPS, or net asset value per share. We'll come back to that one in a minute. So what was the amount of Don's investment after paying for the fee? Well, we know that the total value Don has to invest is $3,025. That's made up of the investment and the loading fee. Now, we know what the loading fee is. It's 4.75% times $3,025. Rearranging this, we can see the total value of the investment is $3,025 minus the front-end load fee. 4.75 times 3,025. So therefore investment must be $2,881.31. That means already that Don has invested his money and his investment is only worth $2,881. He's going to have to make $150 to break even. That's quite important because that means that depending on the type of investments that the fund has made, it might be a matter of several months, perhaps even a year, before Don is going to break even on his investment. So his money is essentially going to be tied up in all practical senses. How many units can Don acquire for his $2,881? Well, at net asset value per share of $10 per share, he can have 288 units with a little bit of change. Now, you remember I mentioned net asset value per share? Essentially, that's the value of the fund roughly divided by the number of shares outstanding, with a couple of small adjustments. Essentially, net asset value per share is the current market value of the entire mutual fund, minus any existing liabilities that the fund has, and any management fees. All of this is divided by the number of shares that are outstanding, and that tells us per share what the net asset value is. So, for example, if we have a mutual fund with $100 million current market value, it has liabilities, perhaps redemptions that are in process of $2 million, and it has no other fees. There are 12 million outstanding shares. To calculate the net asset value per share, 100 million minus the liabilities, no management fees, all divided by 12 million shares. That says that the net asset value per share is $8.17. We know that there's going to be some transaction costs that are going to be involved. There are also going to be the costs of managing the office and also of the sales staff. These we describe as management fees, and any kind of investment has got some. We look for low management fees because we don't actually start making any money on our investments until all of the fees and the transaction costs have been covered. So we look for investments with low management fees. A standard way of reporting this is the management expense ratio. Management expense ratios range from about 0.5% up to 3%. In some cases with insurance products, perhaps as much as 5%. It's deducted before reporting the net asset value per share, and it's has to be disclosed as the management expense ratio. Essentially, management fees divided by the net asset value. Very important, especially in a market where we're perhaps only earning 4 or 5%. If we have to pay 3% in management expense ratios and perhaps another 1.5% to a financial planner that we're working with, there may not be much left over for our investments after we pay all of these costs. Important to know what those costs are. Mutual funds come in a variety of different shapes and flavors. I won't go into the details for all of them, but you can see that some of the most common, including things like money market, mortgage, bonds, dividends, equity funds, all of these things I think are very much self-explanatory. A balanced fund is a balance between different types of investments, including equities and bonds. We have specialized real estate investments, which allow us to invest in things like commercial or residential real estate through a mutual fund. We've got some international or global funds that allow us to invest in particular markets in different currencies. We have specialty funds that allow us to invest in certain sectors or geographic areas. In fact, the term BRIC, the combination of fast-growing markets, including Brazil, Russia, India, China, that particular term was invented by someone at Goldman Sachs who was particularly interested in marketing a fund, trying to raise money for investments in some of these emerging markets. Ethical funds, we'll talk about that in a second, include investing in particular types of companies that are socially responsible or non-polluting or some combination thereof. Segregated funds are mutual funds sold by insurance companies. We have a little bit still of labor-sponsored venture capital funds which allow some tax-subsidized investment, particularly in the province of Quebec. I think there's still a little bit still allowed in the province of British Columbia, where governments provide incentive to fund managers to invest in startup businesses, especially those which are certified by labor movements. I mentioned ethical funds, and that's quite an important and fast-growing part of the investment world. Socially responsible investment is something that many institutions work very hard to market. That means that they will promote investments in companies which might have sustainable activities, including things like alternative power generation, no carbon investments, no tobacco, alcohol, no investments in companies which have oppressive labor practices, and so on. Organizations like Van City, for example, work very hard to promote mutual fund investments in ethical funds. A second type that I mentioned earlier was a type of market or index type investing. This particular type of investing was actually pioneered by a fellow by the name of John or Jack Bogle, who founded Vanguard, one of the biggest fund management companies in the world. Jack Bogle actually invented this as part of an undergraduate thesis he did while he was a finance student. He essentially invented the entire industry, and in his later years spent time traveling around talking at universities about how important diversification is and how this type of index fund actually proves the idea that markets are efficient and that the only way that you can really get ahead is to have a broadly diversified portfolio to be able to invest in an entire index. That's essentially the heart of the original index mutual fund business. And these are funds that allow unit holders to buy shares from the fund in an entire industry or an entire index. Because they're index mutual funds and not actual stocks, they can only be redeemed, they can only be invested one time a day. You can't actually trade in mutual funds the way that you can trade in stocks. Essentially, there is a clearing process which allows redemption or investment at one point during the day. There is a wide variety of performance, even in index funds which track a common index. And that's partly because of the timing of investments and the ability or lack of ability of a fund manager to copy or replicate the performance of that index. As a shareholder or unit holder in a fund, you may find that you're responsible for tax liability that's created from capital gains or dividends, and that this results in creation at the end of the year of a statement that says this is the amount of tax that's owing as a result of your participation. An alternative to the index mutual fund, which has emerged especially in the last decade, over the last 2 decades in general, but become very strong in the last one, are exchange-traded funds. These look a lot like mutual funds, but they're traded on an exchange. And like stocks, they can be traded on a minute-to-minute basis, hundreds or thousands of times per day. Shareholders are buying and selling these shares. The units themselves, or the shares, are created by an investment company. Some of the biggest include companies like iShares, who will create ETF products and market them. They'll collect the money from the sale of the ETFs, the exchange-traded funds, and then they will use that money to invest in the indexes that they follow. You can buy and sell these at any point in time. They only create a tax liability when you earn dividends through them. You receive a dividend payment that creates an income event that you have to pay taxes on. But capital gains are only recognized when you actually sell the ETF. There are a broad variety of ETFs. In fact, just about any kind of investment strategy you can imagine, ETFs have got there first. It has actually led some people to wonder, what is the future for the mutual funds business? Because the ETFs do anything that the mutual funds do, typically cheaper. Type of ETFs, and this list is only partial. It would take a week to go through the list of all of the different types of ETFs that we've seen. Include ones that follow certain markets or indices, investments in bond that allow you to buy government bonds or corporate bonds or a combination of those. Invest following certain styles, growth versus value, large, medium size or small company investments, certain sectors or industries. You can invest in commodities indirectly by buying something like a gold or a copper or a platinum ETF, which will use the money that's raised through the sale of the funds to buy gold certificates, which means that you don't actually have to go out and buy physical gold and find a place to store it. If you want to invest in gold, you can buy gold ETFs. These ETFs work really well, but they don't work perfectly. And so when the price of gold goes up by another $10 an ounce, perhaps your ETF only goes up by a fraction of that. And that's because it's hard for a fund manager to perfectly track some certain kinds of industries. Foreign markets and foreign currencies are other things that we can track with an ETF. So we can invest, if we wanted to invest in India and to invest in rupee, we could actually find an ETF which will allow us to do both of those things. There are special strategies, including leveraged bets. So if we think the markets are going to do well, we can buy a leveraged bull market investment. And if we think the markets are going to do badly, we can buy a leveraged bear market investment. In other words, if the market goes down by 5% and we have a triple leveraged bear investment or inverse investment, When the market goes down by 5%, well, we would hope that our investment in the ETF would go up by 15%. So you can actually bet against the market. The mechanisms of this are complicated. Unusual types of ETFs like this have a higher management expense ratio, higher management cost, and sometimes they don't work perfectly, especially in extreme markets. We were hoping for 3 times the return, we only got 2 times, and that's because there's tracking error. Alternative investments, including things like investing in real estate, commodities, and private equity, is something we can also do through ETFs. Again, smaller market, more expensive. It doesn't work perfectly. Actively managed ETFs essentially means that we're going to put money into an ETF that is going to try to outperform the market by stock selection, by perhaps following one of the strategies that we'll talk about in just a couple of minutes. In an index ETF, the most commonly traded type of ETF, the objective is to track the market. A perfect ETF essentially is going to follow the market and have exactly the same minute-to-minute performance as what happens to the index. So you'll see in this particular chart we have a time series of the index performance for the Standard & Poor's 500 index. Starting off, say, in December of 2021, we've got quite a powerful market, and it drops off quite a bit during January, February, recovers a little bit in April, and then drops from April up until today. If you bought an index ETF, pretty much you could overlay these 2 different charts and see that the performance is almost perfect. Whatever's happened to the market has also happened to this particular ETF. So the upshot of this is that we have very, very low tracking error. And because this is relatively easy to reproduce, it's relatively low cost to reproduce. And the management expense ratio is also very low on a very large, very highly capitalized, and very efficient type of ETF like this one. So we say that index ETFs are extremely low cost because of the lower administrative requirements. They typically perform according to the way that the index is performing. And for the managers of the fund, especially for an index with a small number of constituents, like the Dow Jones Index with only 30 companies in it, it's actually possible to perfectly replicate the index by buying all 30 stocks. Even the Standard & Poor's 500, those are very liquid stocks. They're relatively easy to buy. A very large index like the Russell 3000 index might be a little bit harder. So rather than have full replication, fund managers will use alternative approaches like stratified sampling or optimization with a little bit of tracking error. Now, there are a number of products that emerge every time I do a course like this that are new, that probably didn't make it into the last textbook, might make it into the next textbook, or might even be gone by then. One that's very popular right now, one that we hear about a lot from investment advisors, is a smart beta approach. Essentially, this is described as factor-based investing. If you've done corporate finance, you've seen the term beta used to describe a measure of variance with the rest of the market. So a company with a high beta has high volatility relative to the market. That's one type of beta. It's a measurement of volatility. But there can be other reasons why a company does differently than the rest of the market, including market capitalization. Very large companies, very small companies, medium-sized companies may behave differently. We know that large companies tend to have more stable prices, smaller companies much more volatile. There can be a number of other factors, including things like value versus growth, momentum, and so on. In the case of a factor-based approach, essentially the index is recalculated or rebalanced according to the particular factor that they're trying to use as a measure of the success of the market. We know that in some markets, momentum tends to actually be one of the most important things. A company that has done well in the last 3 trading sessions is much more likely to do well in the next trading session than to do badly. So a direction of trade, a trend, tends to be a good indicator of future trend. Market capitalization, value strategies, and so on. So what essentially happens in a fund that's managed according to a smart beta strategy is the fund manager will focus on one or more of those factors in order to try to produce a better than average return. The empirical results of factor-based investing are not encouraging. Here's some work that was done by 3 professors from London Business School, and this is from a report that they publish every year through Credit Suisse. And essentially they say, take a look at the results over the last 15 years or so. We can see that on a year-to-year basis, the order of performance of all of these factors, including things like volume, income, momentum, size, and value, tended to be quite variable. In some years, low volume was important. Other years, size was important. Other years, value. Other years, momentum. So there's no clear indication that one strategy is better than another. In fact, even between markets, here you can see a comparison between the top and the bottom chart. In the United States, in some years, one factor would be most important. And in Britain, in the same year, that factor would be a lot less important. So there's no clear indication that this particular approach works, although right now it's the most heavily marketed idea in ETFs. And you'll see that certain ETFs have been set up to follow these particular strategies. For example, value or quality or momentum might be the main themes for these ETFs. So if you want to have a factor approach that is based on momentum, you can buy one of these momentum ETFs, MTUM. Now, ETFs are definitely not without risk. They originally set up to produce relatively low-risk investment vehicles. And they work very well, especially for things like index funds, which are very well capitalized, very well run, and have low tracking error. There are some pretty crazy sounding ETFs out there. I mentioned leveraged ones, and in this particular article from US News, they identify, in particular, several different leveraged ETFs. So one here called ProShares QQQ. Essentially, it's a triple leveraged NASDAQ bet, and essentially says that if NASDAQ goes up by 1%, we expect this particular leveraged bet would pay out 3 times that. Now, not only is it taking advantage of volatility, it suffers from that volatility because quite often when the market goes up substantially, the tracking error on these type of ETFs becomes very large. So you were expecting to have a 3 times gain on the upside. You didn't get it. On the downside, you have a 3 times loss, except you got the 3 times loss. So sometimes it tracks well going down, but doesn't track well going up. You'll also find that unusual strategies like this have higher management expense ratios. In this particular case, the management expense ratio is about 95 basis points, or 0.95%, as compared to about 0.15% for an index ETF. Right. I promise this is only a sample of mutual funds and ETFs. This is still a big topic, but I'm going to move on a little bit. Talk about the third type of pooled fund. And that's the one that we see available from insurance companies. This is described as a segregated fund. Insurance companies do not sell mutual funds, but they sell segregated funds. And the way that they justify their entrance into the mutual fund business is that their products are not just an investing product, they're also an insurance product. Essentially, segregated funds sold by insurance companies are different because they they offer to make sure that the principal portion of your investment is going to be guaranteed at maturity or at death. So if you put $100,000 into a segregated fund and you expect to get $100,000 plus a return on your investment, well, they won't guarantee the return on investment, but they will guarantee the principal. So at the end of the investment, you'll receive your full principal amount back, even if the market's done terribly. Or if you die during the period in which you have the investment, they'll also guarantee a full return of the principal. So essentially, they've turned what sounded like a mutual fund into a type of a savings and investment product, a life insurance product. For this particular example, we have segregated products with 100% maturity and death benefit. You're guaranteed 100% of your principal back. Quite notably, for most of these funds, there is a very high management expense ratio, about 5%. So yes, you have a guarantee, but you also have a fairly high cost of running the fund. And essentially, half of that cost is the insurance cost. It's an insurance premium that's built into the cost of the fund. If you go for a 75% premium guarantee, the middle column one, the management expense ratio is lower. And if you have an ordinary mutual fund that's providing exactly the same kind of profit potential, you can see the management expense ratio is about half of that for the fully guaranteed segregated fund. So, yes, there is a guarantee of sorts, but part of the guarantee is the guarantee that you will pay a lot of money in management expense costs. Right. We have been through, in the last 35 or 40 minutes, an introduction to mutual funds, segregated funds, and exchange-traded funds. Most importantly, they offer an opportunity for small investors to create a pool of funds that can help them to build a larger pool of investments to become significant investors in the longer term. Each of these types of investments provides an investment opportunity, a pooled opportunity, but at a cost. And it's important to note that the cost for different types of investments varies significantly from one product to another. Keep an eye on the management expense ratio. And of course, the buyer must be aware. Caveat emptor. Something to finish today's session with. I'll see you soon.